Well, good afternoon. This is Michael coming to you from Scottsdale, Arizona, and it is the 11th of January, 2018. I did a seminar yesterday, and we just went over some of the underlying problems that we're starting to see. We talked about the employment numbers, which came in at 148,000. Some people were forecasting 190,000, and we only got 148. And some said 252,000, and we only got 148. So no matter how you cut it, it was a pretty soft employment number, particularly in the fact that this was coming from, if it's always backdated, so it's coming from December when, we still had an awful lot of people who were still working for Christmas. So kind of a tough number. The JOLTS came in with job openings. That was also very, very soft. And of course, just in the last couple of days here, we have broken the trend line for the 10-year note, and interest rates are going higher. And of course, that scares people. Every time we've broken that trend line, why we have had economic turmoil, and we have a history of breaking the trend line on rates, and we go into recession. So whether or not this will be that case or not, I'm not quite sure. But it's certainly not a good scenario. And of course, if you're in a bond market, it's really a bad scenario because as interest rates go up, the value of your bonds goes down. And we've had it very, very good for the last 10 years, and now we've had a change. So you just need to be aware that we definitely have had a significant seminal event. Things have changed. So you just need to be aware of that. So I just want to mention a couple of things. I think that if the interest rates continue to go up, and I think interest rates can go up a lot faster than a lot of people think that they can, and if they do go up faster, we will certainly push the economy into a recession. Now, Economic Cycle Research Institute has called these turns pretty significantly. I mean, they've called them on time, and they've been correct. Martin Armstrong, who's had a terrific track record of being right. Both these guys, I think, we're heading for a slowdown. Martin Armstrong thinks that we slow down till probably July or so. Then we get a reprieve for a few months, and then we're down for like a year and a half or 2 years. So we really need to pay attention. So if you just think of that, I think that if you have economic turmoil, it generally affects the stock market. Stock market, people take their money out of the stock market, and they try and go to safety. So they'll probably put it in bonds. And I think that there's going to be a window, a very, very short window, where you might get a really good opportunity to see lower rates from here, so that you can refinance and do anything that you need to. So I would start thinking of being a borrower, not a lender, because the borrowers are going to do really, really well. If interest rates go where I think they will, having rates, at these levels, we've been spoiled. We think this is normal. It's not normal. This is really very abnormal to have rates this low for this long. So certainly want to take advantage of that. That would certainly just an easy way of protecting yourself and giving yourself an edge. And of course, if we do start having turmoil, it's probably not going to start here in the United States, but it is going to be probably bond related. And the bond market is many times larger than the stock market, probably 10, 20, 30 times larger than the stock market. So if you have trouble with the bonds, could start in China, could be in Italy. Italy, of course, their banks are in trouble. China, of course, we don't really know for sure, but it looks like a lot of their companies are in trouble there. So, you just have to be prepared. And when I say prepared, what do I mean by prepared? I mean, you don't want to be a casualty of this. Poor people went to work this morning at Sam's Club and the doors were locked. Well, they had no idea. So, these people are not, these are going to be victims. So a lot of people are one paycheck, maybe two paychecks away from homelessness. So let's not allow that to happen, and get yourself out of debt. We've had this extraordinary opportunity where everybody has done reasonably well. I mean, business is fairly good. And we're doing well. I think we can do better, but we're doing okay. So we should really have been getting out of debt, building some reserves, and getting an investment account put together. Because turmoil breeds opportunity. So you can either be a winner or a victim. We certainly don't want to be a victim on this. We want to be a winner, and I think we're going to have some opportunities. And I think we're going to have some opportunities handed to us that are going to be generational wealth opportunities to buy some things. Now, I'm just going to throw this out because I think that I've been talking about this ad infinitum, and I do not want to be boring. So I think that those that are in the stock market have had an absolutely wonderful ride. It's just been great. Sometimes you just need to know when to pull the plug. You know, there's songs, you got to know when to fold them and when to hold them, and when to walk away. And so right now is a really good time for you to start thinking of walking away. Now, we have one of the great advantages that we have in the real estate business. We have a cash flow component. It's many times greater than what you're going to get in the S&P. The S&P is about 1.78%, and we're much greater than that. Typically, we're around 5. Just depending on what we're looking at, do we get able to compress a little bit? We're certainly going to get 4.5. And you know what we do is that we've had here in Maricopa County, we've had such great housing pressure. We've been able to raise rents. So if you took 5 last year, you're probably getting 7 or 8%. But you can't get that in a fixed income. So if you are my age and you need $50,000 a year or $60,000 a year, you may want to enter into the housing market and into the rental market, because we can certainly provide that. And it's fairly conservative. It's not risk free, as we found out in the 2008. However, we're not coming to an ending of our cycle as well. So, and we do have a correction coming. We've been talking about that. But here again, I don't know that it's going to be a correction necessarily in rents, maybe a correction in values, but people will need a place to live. So it's a reasonable place. It's a good lifeboat for you, and you can easily get income this way. So, you know, if you have an income necessity, let us know. We can generally help with that and place some money and get you the income that you need, and put it in a fairly conservative manner so that you can park it so that we can get our money back. So that's what we're really looking for. So. And I would start looking at my bond portfolio. Certainly talk to your investment advisor and get some thoughts. We're always welcome to talk to anybody. But I'd also like to see you start putting some cash aside for yourself. Just getting some cash, and just take a look at your credit cards and any HELOCs. Anything that you owe on, I would certainly start getting rid of and start selling off, and I start putting some cash together, because I think that there's going to be a great opportunity coming. So just now it's time to be aware. So listen, we're here in Scottsdale. I have a staff here. We're here for you if we can help you in any way we possibly can. This is our mission, is to change lives, and we're here for you. So if we can help you, want to brainstorm, ask a question, we actually answer our phones. So my very, very best to you, and God bless you. Bye-bye now.